Welcome back to Iron Financial. Today, we're grabbing our hard hats and safety goggles because we are about to stress test the financial structure of Alliance Laundry Holdings. That's ticker ALH. They just dropped their Q4 and full year 2025 earnings, and believe me, the numbers tell a really fascinating story about operational muscle and some serious financial fortification. In this analysis, we're going to dig deep into the company's blueprints. We're going to figure out if this thing is a bedrock component for a truly durable portfolio, or if there are cracks hiding just below the surface. All right, let's get to work.
So, let's be honest. Commercial laundry systems, it's not exactly the sexiest topic you're going to hear about this week. This is not some flashy AI stock or a biotech company curing diseases. But you know what? Here at Iron Financial, we know that the most powerful, the most durable investments are often found in these overlooked, kind of mundane corners of the market. So, the big question for today is simple. Does ALH's boring business model conceal a rock-solid, grade-A investment opportunity? We're going to put that to the test. We're going to use their own numbers to see if this company is a true portfolio fortress, something that can actually weather any economic storm. All right, here's the game plan for our inspection. First, we're going into the spin cycle setup, just the basic who, what, where. Then we're going to look at the engine room in forging top-line growth. After that, we're putting the pressure on in stress testing the margins. Section 4 is what might be the main event today, reinforcing the balance sheet. Then we'll look at what they're planning for next year in blueprints for the future. And finally, we'll hammer it all home with our verdict. Let's get into it. Okay, Section 1, the spin cycle setup. So, who are these guys really? Well, to put it simply, they are the undisputed heavyweight champion of the world when it comes to commercial laundry equipment. This isn't some small-time player trying to make a name for themselves. This is the biggest, most dominant force in this market, period. They own a whole portfolio of the most respected brands you can think of in this space. I'm talking about the legendary Speed Queen, Unimac, Huge, Primus, Ipso. The list goes on. Their reach is just massive. Yeah, let's put some hard numbers on that. We're talking about a company with a market cap around $4.4 billion. They're in over 140 countries with more than 3,500 people on the payroll. This is a true industrial heavyweight. But I need you to look at that last number, a PE ratio of 36. 36! Let me be blunt. For an industrial company, that valuation is sky high. That tells me the market is pricing in absolute perfection, assuming massive future growth. So my question right out of the gate is the foundation of this company actually strong enough to support a valuation that tall? That's what we have to find out. All right, let's move on and see how they start to build that case. Section 2, forging top-line growth. Look, any company worth its salt needs a powerful revenue engine. It's the first structural pillar we always inspect. We need to see clear, consistent, and most importantly, high-quality growth. So let's crack open their 2025 report and see if they're actually building something that's going to last, or if this is all just temporary scaffolding. Okay, so the scale here is no joke. For the full year 2025, Alliance Laundry hauled in $1.7 billion in net revenue. That number alone tells you a lot about their market-leading position. I mean, think about it. Laundromats, hospitals, hotels, they all need these machines. It creates a really resilient base of demand. But a big, static number like this doesn't tell us about momentum. To see that, we've got to look at the year-over-year change. And boy, is there momentum. Just look at this. They went from $1.5 billion in 2024 to $1.7 billion in 2025. You do the math. That's a 13% year-over-year jump. Now, for an established, mature industrial leader hitting double-digit top-line growth, that is a sign of incredible strength. It screams excellent execution. This is the first solid steel I-beam we're seeing in this company's structure. But a good skeptic always has to ask how. Exactly. Hold on a second. 13% is a fantastic headline number, I'll give you that. But we've got to look under the hood. Where did that growth really come from? Do they just jack up prices on all their washing machines? Because, any company can do that once. It's a cheap trick. But it's not a sustainable strategy. It's like building with flimsy scaffolding instead of solid steel. Is this real organic demand from people buying more machines? Or is this just some inflationary sugar high that they can't possibly repeat next year? Show me the blueprint. And the blueprint is crystal clear. The company gives us the answer right in their report. When you break it down, a massive 70% of that growth came from pure volume. They were physically selling more equipment. Only 30% of it came from price increases. So what does that tell you? This isn't financial engineering. It's real fundamental demand. They are taking market share. They are expanding their footprint. This confirms that their top-line growth is absolutely built on a solid foundation.
All right, so the revenue story holds up. The top line is strong, the support beams are in place, but like the old saying goes, revenue is vanity, profit is sanity, and cash is reality. A building can look amazing from the street, but if the internal supports are weak, the whole thing's at risk of coming down. So now, in Section 3, we're going to stress test the margins. We need to see if their profitability is as tough as their sales growth, especially in a world with tariffs and rising costs breathing down their neck.
And let me tell you, the results of that stress test are frankly very impressive. In the fourth quarter of 2025 alone, Alliance expanded their Adjusted EBITDA margin by 140 basis points. That's 1.4%. They hit a total of 24.5%. For the full year, the margin was a record 25.5%. Now just stop and think about what that really means. While they were dealing with all these headwinds, like tariffs on parts they have to import, they actually became more profitable. That shows incredible operational control. It shows serious pricing power. They aren't just passing on costs, they're actively managing their business to squeeze out more profit. This is a very, very well-run machine.
And you can see that confidence reflected right in the words of the CEO, Michael Schob. He called 2025 a landmark year. He's pointing to the big wins, a second straight year of double-digit growth on both the top and bottom lines, and a significantly strengthened balance sheet. This isn't just your standard CEO happy talk. The numbers we just looked at back up every single word. He is sending a clear signal to the market that the company's operational blueprint isn't just working, it's firing on all cylinders. Okay, I'll grant you the execution has been fantastic. I will. But a fortress is defined by how it stands up to a siege, not how pretty it looks in calm weather. And we cannot ignore the potential cracks in the armor here. The risks are very real. Tariffs are an ongoing fight. Competition in this space is absolutely brutal. Geopolitical nonsense can disrupt their international business in a heartbeat. And I have to say it again, that PE ratio of 36, it just hangs over everything like a dark cloud. The market is pricing in perfection, and this list of headwinds shows there is zero margin for error. One little slip up and that valuation could come under some serious, serious pressure.
Those are all fair points, and any smart investor has to weigh those risks. But this brings us to what I believe is the most powerful part of the Alliance story in 2025. Let's move to Section 4, reinforcing the balance sheet. A company's ability to withstand all those external pressures you just mentioned is directly tied to the strength of its financial foundation. And in 2025, Alliance didn't just patch up a few holes in their balance sheet. They undertook a massive reinforcement project. This, my friends, is where the real heavy lifting happened. In fact, if you take only one thing away from this entire analysis today, it should be this. The single most important, most impactful strategic move the company made all year long was its massive deleveraging. I'm not talking about a minor adjustment. This was a fundamental transformation of their financial risk profile. This is the main event of the 2025 earnings story. Full stop. Okay, just look at these numbers because they are staggering. At the end of 2024, Alliance was sitting on a net leverage ratio of 5.0 times their Adjusted EBITDA. Now that is high. In a world of rising interest rates, that is a huge risk factor. It's a clear vulnerability in their financial structure. Now fast forward to the end of 2025. They brought that ratio all the way down to 2.8x. That is a reduction of 2.2 turns in a single year. That's not just paying down a little bit of debt, that is a seismic shift. They effectively ripped out their old foundation and rebuilt it with reinforced concrete. That drop is absolutely incredible. I mean, seeing a 2.2 turn reduction in leverage in just 12 months, you almost never see that for a company this size. But my job is to be skeptical. So how did they pull this off? Was this some kind of one-time financial magic trick? Did they use some fancy accounting or sell off a core part of their business to pay down the debt? Because if this was just a one-off event, that's great for 2025, but it tells us nothing about their ability to manage debt going forward. Is this kind of strength repeatable? It's a critical question, and the blueprint is actually very clear. It was a two-step process. Now, the first step, you're right, was a one-time event. They used a big chunk of the proceeds from their 2025 IPO to pay down their term loan. That was the big catalyst. But, and this is the absolute key to the whole story, look at step 2. The company also generated $212 million in cash just from its own operations, and that number was up a whopping 46% from 2024. They used this powerful, organic, and totally repeatable cash flow to reduce their debt even further. So they used the IPO as a one-time reset button to fix the foundation, and now they have this powerful, ongoing cash flow engine to keep that foundation strong and keep chipping away at that debt in the future. So the company ends 2025 in a position of undeniable strength. We're talking a reinforced balance sheet, accelerating volume growth, expanding margins. The whole structure is sound. Now, in Section 5, we have to look ahead. Let's examine their blueprints for the future. What is management actually forecasting for the year ahead? What does their official guidance tell us about their own confidence level? All right, here it is, the company's official guidance for 2026. They're projecting revenue growth of 5 to 7% and adjusted EBITDA growth of 6 to 8%. That implies they think margins are going to keep expanding, which is good. They're also targeting even more deleveraging, aiming to get that net leverage number down into the low 2x range by the end of the year. So this all paints a picture of steady, controlled, profitable growth. But I have to point out the elephant in the room. A forecast of 5 to 7% revenue growth is a huge slowdown from the 13% they just put up. Is management basically telling us the party's over, that the period of rapid expansion is done? Because that sky-high PE looks even crazier if growth is about to get cut in half.
That's the perfect bear case argument against the stock right now. But here's how management says they're going to bridge that gap and keep driving value. You're looking at it. This highlights how Alliance isn't just some old-school industrial manufacturer anymore. They are becoming a technology company. Innovations like their ProCapture technology and the Scan Pay Wash appless payment system, these are designed to make the user experience better and drive higher returns for the people who own the laundromats. This is the key to their future. In a mature market, you don't grow just by selling more steel boxes. You grow by selling smarter boxes that solve more problems for your customers. This is their plan to hit those 2026 targets.
Which brings us to our final section. We've run the numbers through the spin cycle, we've stress-tested the margins, we've checked the quality of the growth, and we've done a deep inspection of the balance sheet's foundation. So now it's time to weigh all the evidence. After all of this, is Alliance Laundry a true portfolio fortress? Or is it just a really convincing facade with risks that are way too high for the potential reward? Okay, let's get into this final weigh-in, because this really sums up the whole debate. The bull case, the foundation, is incredibly strong. The cornerstone is that massive 2.2-turn deleveraging. That move alone fundamentally de-risked the entire company. Supporting that, you've got the powerful 13% revenue growth, which we proved was mostly real volume. You've got strong margin expansion, even with headwinds, and a confident management team guiding for more profitable growth. This structure looks like it was built to last. But you absolutely cannot ignore the cracks, the bear case. That PE ratio of 36 is a glaring fault line. It demands perfection. It's also worth pointing out that a big firm like Morgan Stanley only has an equal weight rating on the stock, not an overweight one. That's a big yellow caution flag from the street. The external risks from tariffs and geopolitics, they're still there. And the company's own guidance clearly points to growth slowing down from that blistering 2025 pace. So you're being asked to pay a huge premium for a company whose fastest growth might already be in the rearview mirror. And that's what this all boils down to. It's a core conflict. On one hand, the work they did in 2025 was a masterclass in financial fortification. The balance sheet is a fortress compared to where it was a year ago, and their operational performance is just stellar. But on the other hand, the valuation is a skyscraper, priced for a future with no mistakes. So this brings us to the final question that you, as an investor, have to answer for yourself. With a newly reinforced balance sheet but a persistently premium valuation, has Alliance Laundry truly built a portfolio fortress, or is the price of admission simply too high for the decelerating growth and the very real risks that lie ahead? That's the question we'll leave you with. Thanks for tuning in to Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.